From the morning reading, the Dow Jones Industrial Average leads stocks higher as the Qs hit another all-time closing high. Healthcare drops 1%. Breadth strengthened compared to the prior session as advancers led 2,061 to 942 on the New York Stock Exchange and led 1,498 to 1,266 on the NASDAQ. On the S&P 500 snapshot, a modest gain in the volatile Trump trade. The S&P 500 spent the day in a relatively ho-hum 0.64% trading range from its negative 0.36% low to its modest 0.28% closing gain, but the morning was quite volatile. Why? President-elect Donald Trump held his first press conference since the election, and it was a doozy. His claim that the drug industry is getting away with murder sent the index to its intraday low. He also made the astonishing claim that there are 96 million people wanting a job who can't get one, a claim that was debunked by Steve Leisman at CNBC. But the 500 began an early afternoon rally that took it to a closing gain of 0.28%, which was also the intraday high and just 0.07% below its record close from Friday. The Dow is still having trouble hitting 20,000K. Can't end without taking a look at the Dow Industrial to reach its 20,000 level. Traders still seem to be selling up against that big round number. The hourly bars over the last month show the Dow consolidating between resistance just below 20,000K and support near 19,700. Odds still favor the upside. It would take a drop below its late December intraday low at 19,718 to signal that the attempt has failed, at least for now. Some investors aren't buying this rally. Smart money confidence has dropped below 20% for the first time since last summer, marking one of the few times in 17 years it has declined to this low of a level. While stocks were still able to manage shorter-term gains several times, by 3 months later, almost every instance shows substantial downside, with 66 out of 82 days generating a negative return in the S&P 500. The NASDAQ can't be kept down. The composite index has risen for 7 straight days and to a new all-time record high. That kind of momentum can result in a ramp higher to even greater momentum, but just as often has led to at least shorter-term decline. Overall returns going forward were good, not great. Stocks are lagging the indices though. On the NASDAQ, we've already discussed how several of the recent high in the index were accompanied by more declining than advancing stocks. Then on Wednesday, the index surged to yet another record, yet fewer than 1.7% of stocks on the exchange managed to reach even a 52-week high. That's among the lowest readings in 30 years. For a day, the NASDAQ did so well. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:16 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 12th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were negative, albeit modestly. S&P futures are down about 0.25%. Russell futures down about 0.33%. NASDAQ futures down nearly 0.33%. And Dow futures down about 0.25%. Going the other direction, crude up about 1.25%. Euro up about 1%. Bonds up about 0.4%. And gold up about 0.2%. On the overseas markets, looks like everybody's open today. China down about 0.5%, as is Hong Kong. Japan up about 1.2%. Germany up about 0.2%. I should say down about 0.2%. And United Kingdom down just below scratch. And macroeconomic reports for today of note in the United States, you have the weekly unemployment claims. FOMC member Evans speaking, as is FOMC member Harker speaking. Import prices, the weekly natural gas storage report, the 30-year bond auction, and then also note tonight after the market close, Fed Chair Yellen is speaking. And looking forward to tomorrow, U.S. macroeconomic reports of note. You have core retail sales, PPI, FOMC member Harker speaking, and the University of Michigan Consumer Sentiment Report. So quite a bit of activity between today and tomorrow on the scheduled reports. Okay, let's go ahead and bounce over to the charts. And on the S&P futures, basically just a continuation of the sideways consolidation. Just about all the trading action in the last week can be readily contained within a box. And that really is just a continuation pattern that is building on the last 3 weeks. In fact, much of the action could be held within this first bar of much of this price action. And the Dow, also the exact same pattern, very, very much sideways consolidation. NASDAQ, of course, has been different, and we talked about from the morning reading authors about how we've had this whole series, and certainly this is very, very strong bullish action. Look at all these higher closes, and many of these closes near the highs of the day or near the close. Also, we should note that the bodies seem to be getting a little bit smaller, and yet you take a look at yesterday's action, very, very strong closing action, closing right at the high of the day. But then within this, we start to look and we find out, as the morning author pointed out, that the breadth is woeful. And as we look at some of the most important components of the tech sector, we take a look at Facebook. Well, relatively strong in the very short term, and now above its cloud, it's well off its 52-week high. You took a look at Amazon, well off its 52-week high, but again, now above the cloud. So some of these big tech components have improved of late, and yet at the same time, certainly not pushing their own respective all-time highs. You take a look at Google. Google, probably the closest one of the FANGs to its all-time high, but certainly not setting new all-time highs and still just having to come into range. And let's see, who are we missing here? Well, we'll take a look at Apple. Now, Apple has been leading a charge of late. You see, with recent action of this week, did come in to new 52-week highs. These are not all-time highs by, I'm going to say that. We've had all these stock splits. I'm trying to remember the numbers. Just a second here. So, well off our all-time highs on Apple. Split adjusted, you would need to get back up to the 135 area, and obviously right now we're around 120, but we have taken out recent highs with our action. And there we go, back to there. So a number of these important tech sectors are performing relatively well short term, but certainly not the breadth that you're looking, and certainly not the leadership that you're looking for from these really important contributors to the NASDAQ when it's setting its own all-time highs. Okay, let's take a look at some of the other markets. Well, first of all, the Russell. The Russell did have an interesting undercut of this channel, but has bounced right back up, and really the primary pattern here seems to be one of a rectangle, and until we get out of this sideways consolidation in a pattern very much like the Dow and the S&P, this is all just noise within its channel. Okay, crude oil. Crude oil, of course, had the interesting undercut of its prior area of resistance turned support, but then promptly reversed that undercut and is right back up into the prior trading range in recent price action. And then, of course, gold. Gold continues this really amazing counter trend surge and is approaching the cloud, having moved up through a number of important moving average lines and the like. So this question starts to become, is this a true trend reversal, or is this just a strong counter trend move within the context of a strong bear intermediate term trend? When you look at bonds, you see the same kind of pattern, and indeed bumping up against the bottom of a pretty thick cloud at this point. But then you look at dollar, and the dollar, look at this move, and since yesterday's high, which was up around almost 103, we're currently trading down here, about 186 cents. So, big move on the currency market, and that certainly is a big part of what's going on in those markets of gold, crude, and in bonds. So let's take a look at the volatility. Volatility continues to kind of play around on this kind of floor, very, very low level. Obviously, not a lot of fear being taken into account in the broad market right now. Very few puts being bought on the S&P. Very, very complacent market. And usually that doesn't end well for those that are complacent. The old question always comes down to is when. And this can persist for quite some period of time. Perhaps as we're coming into the inauguration at this point, perhaps people are starting to kind of go into a wait and see mode to see what actually comes out in terms of the first 100-day agenda. I'm not sure what other explanations would be for so much complacency at this time of year, especially. Other than that, but whatever it is, it's been priced into the market. It's here. We have to recognize it. Bottom line is that we generally look at this and expect, some expansion of volatility in the future, and we start to watch for those signs and symptoms. Let's go ahead and go to the daily report, and not a lot of changes from yesterday. The top, of course, is about market condition, market posture, and our market timing signals. The first thing we take a look at, the intermediate term phase opinion, market phase 3, bull flags and bullish continuation patterns. Obviously, that is supportive of a bull market. The three market timing signals, all mechanical in nature. The first one coming to us from IBD, confirmed uptrend, that's bullish. The second one, GMI index, a 5 out of 6 buy signal in place since 11:10, that's bullish. And the third one, stock charts decision point scoreboard, this one is decidedly mixed on the short term and the long term, with an abundance of mixed signals on both those time frames, while the intermediate term is universally bullish. We have seen, as a result of these kinds of signals, the expectation and history of the market being slightly bullish, with periodic new highs being put in, also not terribly robust generally, and then also not terribly fearful retracements and corrections within those kinds of market settings. And that certainly is the expectation in terms of a probability outlook right now, unless some new energy comes into the market. Position sizing opinions from the investor side, that model comes in at 100%. The active trader volatility-based model also comes in at 100%. Intermediate term market posture, an exceptionally strong bull, and it's supported by an exceptionally strong bullish sentiment line. And you see 3 of the 4 indices are in that exceptionally strong bull camp. The Russell is in a weak bear camp once again. That's having flipped back to the bearish side. Hedge warning status remains 0+, normal with some elevated conditions. In terms of the 3 strategy opinions, no changes from yesterday. That VIX is still below the acceptable range to initiate new positions for novice traders. We have noted in our prior videos of late how this has been kind of flipping back and forth between that threshold of 12. We consider anything less than a 12 to be getting somewhat questionable about the amount of premium that you take in versus the amount of risk that you take on for those novice traders, as to whether that's a good idea to be putting on trades. So kind of keep that in mind. In terms of specific areas of warning, most of this stuff in the volatility area continues to be about this expectation of an expansion of volatility coming at some point in the future. So we're starting to continue to, continuing to watch for those signs. Distribution day count on the NASDAQ's at a 5. If it drops to a 4, that will drop out of warning status. Under the trend-based area, everything looks fine here. Intermarket risk aversion indicators still got 1 risk on against 4 risk off. From a sentiment standpoint, we're a little above neutral, so relatively benign compared to where we've been. You look at a month ago, a week ago, this sentiment has been dropping. From a sector-specific performance, you see the winners yesterday: energy, utilities, materials, tech, industrial. So mostly risk on, with the exception of utilities being up here in the number 2 performance position for the day. And you see in the negative performers, real estate and telecom. You know, of course, healthcare took the hit with the Trump comments during his press conference. So not too much to make in terms of a big risk on or a big risk off kind of day here. Just generally probably broad-based bullishness. And you see in terms of market posture by sector, by time frame, consumer staples, energy, and retail are the 3 weakest sectors across those 3 different time frames, while others are performing better. But that word better is a relative term. If you look now at the 5-day, the 1 month, now that we've started to stabilize since the post-election run-up, you know, an awful lot of these sectors really haven't gone very far in the last 1 month, either up or down. So kind of keep that in mind. We had the huge post-election surge, but much of that's already kind of stabilized, and these markets are all just kind of in a sideways motion. And that's true whether you're looking at sector-specific or you're looking at the broad indice. Nobody's particularly become a hero of late. Okay, I think that's probably enough for today. So let's go ahead and wrap this thing up. And frankly, I've recorded most of this twice with a flub on the first time, so I'm about ready to be done with this today. So I'm going to go ahead and get this thing published. But got to do the disclaimers as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We should be back here next time with the Falcon Global Market Preview for Friday's session. In the meantime, manage that risk profile, look for that consistency, and then, of course, seek to learn something about your trade craft each and every trading session. Good trading.